Well, good afternoon, everyone. I'm Jim Haggerty, the CEO of Bartlett Wealth Management, and on behalf of the entire firm, we're very grateful for your support and interest. More than 270 are joining us today digitally, and that includes some attendees outside the United States. So we are very, very grateful for your interest and your support. Now, as we meet here today, we're in a bear market. The stock market is roughly 20% below the record highs we reached in January. And the bond market is also down, and that's historically unusual. Over the years when we have had significant shakeouts in the stock market, the bond market has generally gone up, thus providing a nice counter in balanced portfolios, bonds holding steady or going up when stocks are down. This year, both of those major asset classes are down significantly, and certainly a difficult year, one of the most difficult years for balanced investors in our memory. And the culprit in all this is, of course, the inflation surge that we've experienced here in the United States. And frankly, an inflation surge that's global in scope because it's manifested elsewhere, Western Europe, Canada, Great Britain. It's really been problematic, and we'll have more on that later. Now, for me personally, it's my 9th bear market since I started my career. The first bear market I ever experienced was in 1990. I was a rookie, a raw rookie, and the country lapsed into a recession late in the summer of 1990, and that was further complicated by the beginning of the first Iraq War. And I can remember, to a newcomer, it was all pretty rattling. But here we are, 32 years later, and 8 other bear markets. And of course, for the firm, so many more than that. Some of my colleagues, Mike Cameron, for instance, in his career, 15 or 20 bear markets. And so the idea of resilience and instilling the kind of disciplines that help us counsel clients through bear markets and make sure that bear markets don't threaten their financial plans, and in fact, maybe become nice opportunities rather than threats. That's really, that whole idea of resilience is one we'll come back to later on in our presentation. I am happy to tell you that notwithstanding all the market turmoil and an economic slowdown, Bartlett is doing well. Bartlett actually adding people. Not a day goes by that you don't read of major companies embarking on things like hiring freezes or layoffs. And quite the contrary, we have added 10 new professionals this year. And these are professionals in the areas of investment management, financial planning, client service, technology, also very, very important to sustaining Bartlett's legacy of serving clients well. And so rest assured, we're investing in our future, not battening down the hatches as some other companies are, but really being forward-looking and focused on growth. I'm also proud to tell you we've had some very nice recognition this year. For the 4th consecutive year, Bartlett made the Barron's annual listing of the top 100 investment advisors in the country, the top 100 RIAs, registered investment advisors in the United States. It's our 4th consecutive year on that list. We're not resting on our laurels. We ranked 56 in that list of top 100, so we want to keep climbing that ladder. Maybe the nicest statistic that I can share with you, and I share it with a great sense of humility and thanksgiving, is that we are tracking for another year at 98% or more client retention. And that's very, very important to our firm. We measure ourselves that way. And we've had good growth in new clients who largely come by way of referral from many of you who are listening, longtime clients. So just very, very grateful for your support. The theme of our presentation today is around resilience and building resilience into client financial plans and investment portfolios so that we can get through bear markets and make sure clients enjoy the long-term rewards that markets have provided and that we're confident will continue to provide. We have a very good panel today. It will be moderated by Brian Antenucci. Brian recently celebrated his 10th anniversary with Bartlett. He's a managing director and a principal of the firm and helps oversee our equity investment process. The panel will include Aliya Riddle, like Brian, she is a chartered financial analyst, and Aliya is a wealth advisor here at the firm and has a wonderful specialization in the area of ESG, or environmental, social, and governance investing. Matt Stith, in his 16th year with the firm, like Aliya and Brian, he's a chartered financial analyst, and Matt is the director of our equity research and a portfolio manager for our equity model portfolios. And late breaking news, just yesterday, Matt was elected a principal of the firm. So a wonderful honor for Matt and well deserved. And then finally, just an all around good guy, Jason Katz. A lot of initials after Jason's name. CFP, that stands for Certified Financial Planner. CPA is Certified Public Accountant. CEPA is a Certified Exit Planning Advisor. Jason's built a very nice practice advising small business owners on things like succession and exit planning. Perhaps that'll be interesting to some of our listeners, but just a terrific professional who joined our firm 5 years ago. And so with that, I'll finish my opening remarks and turn this over to Brian Antenucci, who will take it from here.
Well, thank you, Jim. Inflation and recession are the two biggest words that have been impacting markets this year. So today we'll give you our insights into the data regarding each of these topics. Another major theme our research team will be tackling today is the impact of reshoring and supply chain protection that we've heard so much about this year, and their impact on both consumers and companies that we invest in. We also have the midterm elections, just happened last night, and have some of the results today. And on November 9th, we're seeing a little bit of the market reaction to that. But we have some more historical data regarding midterm elections that we'll share in a minute. And we'll wrap up our discussion with some actionable financial planning ideas in conjunction with our investment strategy. So our main takeaway for you today is that Bartlett is building resilient investment portfolios and dynamic financial plans that are customized to meet your needs. And your portfolios and financial plans are designed to meet your needs in any condition and are stress tested, in fact, to do that. So let's begin by taking a look at some of the market and economic data so far in 2022. So as Jim mentioned, and you can see all the way on the left-hand side of the screen, neither stocks nor bonds have been spared this year. US large cap stocks through the end of September down 24%. And bonds in general measured by the Barclays aggregate down 15%. Now some more intermediate bonds are down maybe closer to 10%. But the third circle there, which you may find interesting, is that the earnings for these US large cap stocks are actually anticipated to be up 6.5% this year. So the reason that stocks are down this year is that the price to earnings ratio has come down significantly. So a PE ratio is the price you pay for $1 of a company's earnings. this PE ratio at the beginning of the year was at 21 times, and now it's declined to 15 times earnings. That's a 30% decline in this ratio. Now, this decline is largely due to the rise in inflation and therefore interest rates this year. So this was the fastest increase in interest rates by the Federal Reserve in the first 9 months in history. We've had 7 interest rate hike cycles by the Federal Reserve in the last 40 years, but none that's been as dramatic as this one. The other reason that the bond market is down so much is that it wasn't priced in at the beginning of the year. In December of 2021, the Fed told us that they were forecasting the Fed funds rate to increase by 1% by the end of this year. And now we're at 4% and on our way up to 4.5%. So that's a huge divergence that neither the stock or bond market were prepared for this year. So now the Federal Reserve is committed to fighting this inflation. It's part of their mandate, and therefore slowing down the economy and taking risk assets with it as well. Stocks, bonds, real estate. It's a part of the formula. So the next thing everyone's worried about is what level of damage is this going to cause? Will it be a slowdown, a mild recession, or a deeper recession like we saw during the financial crisis? Now, as many of our clients have observed, when they turn on CNBC, the strategists quoted are all across the board. Even just this morning, Jim Paulson from the Leuthold Group was talking on Bloomberg about the probability that 2023, we don't see a recession, and that just a mild mid-cycle slowdown with no GDP declines is probable. And then you have Morgan Stanley's Mike Wilson that's calling this rally that we've seen from these September lows just another bear market rally, and there's a more severe recession ahead. So markets typically go down at the early stages of a recession, and then they start to rebound when the market believes there's some visibility into this economic recovery. Now, this next slide shows the history of our economic cycles when the economy is expanding in green, shown by the number of months, and then when the economy is contracting in blue. And when we total this up over the last 100 years, our economy is expanding 82% of the time versus 18% in a decline. And again, the reason we worry about these recessions is because they're painful periods for the markets. No one likes looking at their statements during these periods of decline. We don't like it. We're investing in the same stocks and bonds that you are, and it's painful for us as well. However, resilient portfolios, as Jim mentioned, going back to 1990, have generated a positive long-term return through multiple periods of time. And again, the S&P has generated that 10% annualized return since 1990. So these painful corrections and the volatility in the market is the cost of achieving these long-term returns for disciplined investors. So let's talk about inflation for a minute. The Fed has told us that they're focused on bringing down inflation, and it's significantly higher than the Fed needs to ease on their path of rising interest rates. So what this chart does is looks back at headline CPI, the Consumer Price Index, going back to 1980, and that's in the blue. The 40-year average of this measurement is 2.8%, and that's the dark line you can see cutting across the screen. And we're now experiencing the highest inflation going back to the early 80s. And over this time period, it's a very volatile measure. It never stays right at that 2.8%. So to use a hockey analogy, we're always looking to forecast where the puck is going, not where it is today. And the next chart shows a zoom in on that same inflation data, the Consumer Price Index, in blue. And again, looking at a shorter period of time here, this shows the dotted green line is where the market believes inflation will be coming down to in the next couple of years. So as you can see in this chart, the market expects inflation a year from now to be growing less than 3% a year, and on down from that in years 2 and 3. Now, this is based off insurance-linked bonds that are priced in the market, mostly pension funds and actuaries that are extremely smart and have lots of liabilities to protect. But it's where the market's pricing in. It's not Bartlett's prediction, but this is what we're seeing out there in the market, is that we're going to see a decline over the next year, getting down to that rate is what the market is telling us. So moving to a timely topic, we just had the midterm elections yesterday, and we believe the market doesn't think in terms of red and blue, but it does think in terms of green. And using a Jerry Maguire movie phrase, the market says, "Show me the money." So midterm election year volatility has usually turned into an opportunity for investors. So when we look back to 1962, every midterm election year has had a pullback. And after these pullbacks, the S&P 500 has been positive in the 12 months following a midterm election in every instance since 1962. So you can see these pullbacks in the market in blue, ranging from down 7 to down 38%. The following rally from these pullbacks ranges from positive 9% to positive 58% a year later. So this is regardless of political party and the White House and who controls Congress. The third year of an election cycle is historically the most favorable to the stock market. So we're cognizant we can't hang our hats on a post-election bounce. Certainly a lot of factors at play, and we're going to talk about those. And as our first speaker, Aliya, will tell us, we have to look beyond our borders to get the full picture, risks and opportunities alike. Although this year has been a tough one for the market, I hope our speakers today are able to instill a sense of calm, not because the market is going to new highs at 3 o'clock when we end our presentation, but because we're fully dedicated to this idea of resilience. As I mentioned before, the economy has historically grown 82% of the time, and high quality investments have yielded healthy long-term returns. And careful planning provides comfort in both good times and bad. So let's dive deeper into some of the major themes we're researching, starting with Aliya. And in Aliya's work, she oversees our ESG team, as Jim mentioned, environmental, social, and governance. And to clarify, this is not an overarching investment filter for all Bartlett clients. However, some private clients and non-for-profit clients, institutions, have mandates in their investment policies on what sectors and industries we can invest in based on their beliefs. So in Aliya's ESG research, she's particularly focused on global themes. So Aliya, walk us through what trends you're seeing right now.
Brian, you touched on a few of the items that are influencing current market volatility, but I wanted to take a few steps back and look at a couple of the broader themes that are weighing heavily on markets today. So those two themes are both D words, deglobalization and decarbonization. So not only would each get you about 500 points in Scrabble, we also can't emphasize enough how much of an impact these themes are having on companies and consumers and governments all over the world. Our job as advisors is to understand and interpret these developing themes and how they will impact not only our investment selections, but also client portfolios in the long run. So deglobalization can be broadly defined as the process of diminishing interdependence between countries around the world. It's often used to describe times when trade and investment between countries decline and countries look inward in order to satisfy consumer demand. It's also helpful to keep in mind that while we traditionally talk about deglobalization in terms of global trade, it can also have social, cultural, and political ramifications as well. So we've truly spent decades nurturing this global economy, as told by the multitude of items that we import and export daily, in addition to the multiple factories that we have in countries around the world. But really now, COVID shutdowns, geopolitical instability, and shaky, sometimes non-existent supply chains have led countries to trying to figure it out themselves. And
One thing I'll make mention before we continue on with these themes, Aliya, is on the Q&A function that we have, because we want this to be an invigorating conversation and handle your questions. So in the Q&A box at the bottom of your screen, if you want to ask a question, you can do so in that chat box. And if we're not able to get to your question and you'd like your Bartlett advisor to follow up with you, please put your name in that question as well. Otherwise, the questions come through as anonymous, and we'd like to handle everyone's questions towards the end of our presentation. So Aliya, that's a major pivot. We spend the last 40 years, globalizing our supply chains and really exporting a lot of inflation. So what impact is this deglobalization and reversing this trend going to have on both companies and consumers?
Well, as we're all too aware, inflation is a word that has entered our daily vocabulary. And in short, it's reasonable to expect higher inflation in a deglobalized economy relative to what we enjoyed prior to the pandemic. So for US companies, rather than continuing to export manufacturing to lower cost alternatives outside the US, they will shift production back home where costs are higher. So higher input costs usually means higher prices that consumers have to pay for goods. And here we are at inflation. But the trade-off for these higher costs is a more reliable supply chain, which helps companies meet demand. However, the reality is that many companies won't be able to bring their entire supply chain back home. That brings up the concept of nearshoring, or the practice of moving production to the closest country with a qualified workforce that has lower costs and potentially less of a time difference. Doing so may help alleviate some of the headaches associated with relying on components from less stable sources. So Mexico is actually a good example of a country that is quickly becoming a desirable destination for a number of US companies. And so this is really one way that we see companies creating resilience in their operations by diversifying and therefore stabilizing their supply chains. I alluded earlier to deglobalization having political implications, and China is really the perfect example of that. So if many of you will probably recall from numerous headlines, US companies have made efforts to transition away from a reliance on China. But there are risks associated with isolating China in this way. It could destabilize the global economy. It could make relations with China even icier than they are today. And it could also risk retaliatory efforts from China and its allies. But nevertheless, with encouragement from the US government, many companies are moving forward with plans to relocate their production away from China.
Yeah, it's clear that these inflation issues are going to have a global impact in changing around their supply chains. Companies and countries have had to deglobalize themselves from Russia earlier this year, and that is causing a lot of pain globally, but especially for our European allies. Matt, turning to you, our Director of Equity Research and newest minted partner at Bartlett. Matt, and your work, which is very heavy on technology, can you give an example of a company that's reacting to some of these de-globalization changes Aliya just described?
I can, Brian. Yeah, thanks. So a good example of a company that is broadening its supply chain and diversifying outside of China is Apple. Apple is a highly innovative company with an excellent forward-thinking management team. Some years ago, Apple realized that they were far too reliant on China for the production of things such as iPhones, iPads, and other Apple-related devices. So as a result, they began to expand outside of the China region and into areas such as India and Vietnam. While China is the largest and most important supply base for Apple, these other regions are growing in importance. In fact, some of the new iPhone 14s are actually being produced in India for the very first time. And I recently read an article that talked about how a number of Apple suppliers are moving facilities back to the United States so that they can be closer to the company in order to serve them better. While Apple hasn't avoided all the supply chain headaches and headlines that we've seen, this gradual movement outside of China has certainly helped soften the blow. And while we don't expect Apple and others to completely exit China, we do like the more diversified approach to supply chain management that we are seeing today.
Yeah, the resilience of these companies certainly speaks to why they've been such great historical investments, but it's good to see that they're, better late than never, making some of those adjustments. Aliya, bringing it back to you, deglobalization has its challenges for companies and consumers, but how about that other, 500-point Scrabble word you mentioned earlier, decarbonization? How is that impacting companies globally?
Yeah, we really recognize that the concepts of decarbonization and climate change are hotly debated, and we're not here to pick a side. We'll leave the arguments to the dinner table at Thanksgiving, but we really consider climate change implications from the standpoint of how it affects businesses that we look to own. So we want to find out truly who is nimble enough to keep up with and benefit from these rapidly changing regulations. So Brian mentioned that the midterms happened yesterday with some results still in the air, but companies don't really care who's in political control. Companies care about the rules of the game, especially those that are operating on a global scale. So if companies know the rules, they can start to pivot operations to reduce costs, enhance profits, and lower the risk of penalties for non-compliance in the future. So considering all of that, decarbonization is one of the largest worldwide efforts in place to combat climate change. Around 75% of global greenhouse gas emissions comes from the burning of fossil fuels for energy. And through our work developing strategies for clients who are interested in ESG, we're aware of and learning more about daily about the various initiatives to bring that 75% down. So globally, countries have agreed on emission reduction goals. One of the most recognizable is the Paris Agreement from 2015. Its goal is to limit global warming to well below 2 degrees Celsius compared to pre-industrial levels. Corporations are also rolling out their own plans to reduce their carbon footprint with net zero emissions by 2050 as a common goal. However, many people are wondering how we'll know if companies are actually making progress. And there are growing calls for more stringent reporting and disclosure requirements to help illuminate the activity and the progress that companies have made.
Mm-hmm. Yeah. And, taking that theme a step further, one of the companies I've heard you mention before to that end is GE, and, has such a big local, Cincinnati presence here, but, talk about some of the work that GE is doing, to that end.
I recently read that GE has actually successfully tested jet engines using 100% sustainable aviation fuel. So this sustainable fuel is made up of a mix of kerosene, fats, oils, and greases from places like solid municipal waste. So the benefit of this fuel is that it's called a drop-in fuel, which means it's compatible in both current and future engines, so that it doesn't need a huge change in infrastructure to be able to use this fuel. I know you're thinking, Aliya, you want me to fly on a plane that's fueled by garbage, and I know it sounds crazy, but I do want you to do that only because these types of developments are what's going to help GE reach its 2050 net zero targets. So transportation accounts for 27% of greenhouse gas emissions in the United States. So if we can create sustainable fuels for airplanes, then sustainable fuels for cars and trucks is another logical path. There are numerous possibilities for companies to take this concept a step further and apply it to other facets of everyday life. So while we've seen pockets of success, overall the low carbon transition has been slow and costly due to a number of obstacles. BP does a review of world energy every few years, and the use of fossil fuels for primary energy has decreased only 3% over the last 5 years. Wind and solar reach just over a 10% share of power generation in 2021. So this shift, while it seems slow, still demonstrates more of a global commitment to decarbonization by using renewable energy. The real risk here lies in companies not taking any action, no matter what side of the debate that they fall on. And overall, we want to invest in companies that are managing risk by building resilient supply chains, adapting to evolving regulations, and innovating in order to capture these opportunities as these themes develop.
Yep. Thanks, Aliya. I was surprised to hear just how little of a decrease in carbon usage we've had from 85% down to 82. So, turning to Matt, we've, used that investment theme as an opportunity of, wow, if we're at 82%, there's a long way to go. I think, you've invested in NextEra Energy as a renewable energy company. Can you, talk with the group a little bit more about that company?
Yeah, certainly, Brian. So NextEra Energy is a really good example of a company that participates in the renewable energy space. And while maybe not a household name yet, we think it will be one day, as NextEra is a major player in renewable energy, such as wind and solar power. NextEra is actually two companies in one, Florida Power and Light, which is a very well-run traditional utility, and then NextEra Energy Resources, which is home to the company's renewable energy businesses. I think all of us are aware of the importance of renewable energy, and this is something that's really come center stage with the recent passage of the Inflation Reduction Act, which helps pave the way for future renewable energy growth in this country. Now, we started investing in NextEra Energy several years ago after we began exploring the idea of renewable energy, and we came to the conclusion that this was a very attractive long-term growth opportunity. We felt that as a market and global leader, that an investment in NextEra Energy was a great way to participate in this long-term theme.
So Matt, we've talked about different themes during our strategy updates in years past, and whether it's the Internet of Things, artificial intelligence, cloud computing, how does decarbonization and other themes work its way into our process, into actionable items?
Yeah, it's a really good question, Brian. Through our research process, we come across many different concepts and themes. But really what separates kind of the winners from losers is kind of what I talked about with NextEra. It's the longevity of that growth opportunity. Specifically, we're looking for something that has good long-term secular growth. And then we have to find a way to participate in that theme through a high quality investment like NextEra. So a lot of concepts and ideas kind of come across our desks, but in order to be of interest to us, it really has to be something that's different and that we can participate in it with a really high quality company.
Yeah, great. That's helpful, Matt. And maybe backing up a little bit, I think it's important to touch on, how Bartlett approaches its investment research process. This current environment is very challenging, and it's helpful to look at the tools that Bartlett has at its disposal, and just how we're implementing that at Bartlett.
Yeah. Okay. So given what's happened to the markets this year, I do think it's important that we spend some time reviewing our investment process, specifically as it relates to individual equity selection. So I want you to get comfortable with and certainly have a high degree of confidence in what we are doing. I want you to understand our investment process, our goals and our philosophy, and how we strive to achieve these regardless of market conditions. But to begin with, I want to highlight that this is truly a team approach. Our equity team consists of 6 team members who bring years of experience, divergent viewpoints, and differentiated thinking, all while working under a common philosophy and goal. Included on this team are 2 dedicated in-house research analysts and 4 of our senior level advisors. Our fixed income team consists of three of our senior level advisors. So our philosophy really centers around delivering our clients a balanced portfolio of stocks that will generate positive risk-adjusted returns through an investment cycle. And when we think about returns or performance, we do think about those over an investment cycle as we take a long-term approach, knowing that we're going to encounter both up and down markets along the way. Our goal is to put together all-weather portfolios that will do well in up markets and do better than market averages during periods of decline. And when thinking about investment opportunities, we look at companies that are market leaders, have meaningful competitive advantages, have strong financial characteristics, have good growth opportunities, are innovative and adaptive, and are providers of differentiated technology and essential services. And of course, valuation, or what we pay for that stock and how risky that stock is, are important considerations as well.
Yeah. Well, tag teaming on that risk theme there, the concept of risk management tends to come up more when we're having down markets, and not when the markets are smooth sailing and going higher. Can you explain a little bit more about how Bartlett prepares for these down markets in advance as part of our equity research process, and how we're creating resilient portfolios?
Yeah, you're exactly right, Brian. So for us to achieve our goals, especially in down markets, controlling risk becomes even more important. It's something that we spend a great deal of time on. And while this starts with buying best of breed companies that we consider to be high quality and trade at reasonable valuations, there are other things we do to assess overall portfolio risk and to balance portfolio risk. This includes stress testing our portfolios to see how they are projected to perform under different scenarios, such as large market declines, periods of rising interest rates, or higher inflationary environments, all the things we're seeing today. Thinking back to the beginning of the year, we actually stress tested our portfolios for a 20% market decline. Unfortunately, that 20% decline has become a reality, but on the positive side, our portfolios have performed in line with expectations, giving us a lot of comfort in our risk assessment.
Well, another thing I know that you, myself, and the rest of the team spent a lot of time doing this year is adjusting our sector exposures. From the risk management perspective, can you talk about why we do that?
Yeah, so another way in which we can adjust or control risk is by adjusting our sector exposure or sector weightings, as well as increasing or decreasing the position size of some of our individual equities, our individual stocks. So for example, if we are in an environment where we're looking to lower overall portfolio risk, we might look to increase our exposure to some of the lower risk or lower volatile areas of the market. That could be utilities, maybe consumer staples, or even healthcare. At the same time, we could look to increase the position size of some of our more defensive oriented businesses. We can also control risk by blending both value and reasonably priced growth stocks, as they tend to perform differently under different market environments. So I think a good analogy to our investment process is the game of baseball. And by this, I mean we are patient in our approach, and we're largely focused on hitting singles and doubles in our investment selection process. We believe that this will result in a high batting average, or in our case, good long-term consistent investment results. While it's great to hit triples and home runs, and we sometimes do, that type of strategy often results in more strikeouts and outs, something we hope to avoid. For long-term success, we need to be on base and in the game. The baseball season is long. It consists of 162 regular season games. And while the goal is to win every single game, the reality is that that's just never going to happen. There are too many variables, and there are just far too many opportunities to lose. That's really not all that different than investing in markets. And while we too want to win every day, we accept the fact that this is just not going to happen, as we can only control so much. However, we want to do whatever we can to make sure we put ourselves in the best position to win long term.
Yeah, well, staying on the baseball theme, of course, we try to execute a better record during the season than the Reds did this year. Above 500 is, of course, the goal. So a big part of our investment process is repetition. We're meeting every Tuesday and Thursday with our research teams and really diving into actionable items. Can you share about why repetition is so important in our process?
Certainly, Brian. We are big believers in process, and specifically a consistent, repeatable process, as we feel that a good process results in or equals good results over time. And this is really important because there are so many challenges that impact markets over time. We do our best not to let these influence how we go about investing. So whether the headlines are good or bad, or economies strengthening or weakening, we don't deviate from that process and goals. We monitor and we understand these macro headwinds and risks, and we incorporate them into our thinking, but we don't let them dictate overall process. We stay true to that process and philosophy, and we feel that by investing in high quality, well-managed companies that are innovative and adaptive, we can navigate these challenging times more successfully.
Mm-hmm. Well, I think to highlight our investment process, you wanted to talk about analog devices. And this stock's been challenged this year, as most semiconductors have, due to global supply chain issues, buzzword of the year. And of course, you hear about the cars that are stuck in different parking lots waiting for these semiconductor chips. And just anecdotally talking with a client on Monday, and said he's been waiting since June, and all they're waiting for is a chip for that. So can you speak to your thoughts on this company to help highlight our investment process?
Yeah, I'd be glad to, Brian. So Analog Devices is one of those companies that we feel has the agility to navigate many of the challenges that they and others are facing today. We first identified Analog Devices through our investment research process a good many years ago. We've owned the stock for quite some time. And by way of background is, kind of as Brian mentioned, Analog Devices manufactures semiconductors, and specifically semiconductors that are used in more commercial and industrial end markets. So these are businesses that tend to be more sensitive to the overall direction of the economy. And given the cyclicality of the semiconductor business, Analog Devices has adopted a more flexible manufacturing model to produce their semiconductors. So by this, I mean Analog Devices uses both internal and external capacity in the production of semiconductors. So for example, when demand is strong and the company is operating its facilities at high capacity rates or high utilization rates, as we've seen in recent years, they will look to add additional capacity by working with outside contractors or suppliers. And then as things begin to slow, they can reduce their reliance on these outside contractors. They can bring more capacity, or they can bring more production back in-house in order to keep the capacity high and preserve what historically has been very consistent and attractive margins and profitability levels. So while we know that there are risks to owning semiconductor names, we take comfort in Analog Devices' past successes in both good and bad markets. So the point of this example is to highlight that by investing in companies like Analog Devices, we don't feel the pressure to sell when things get tough, as we have a high degree of confidence that our companies can navigate these challenging times, all while continuing to innovate and invest in their businesses for the future. So I hope you have a better understanding of our process in the rigor that we go through in identifying investment opportunities, and take comfort knowing that we're going to remain disciplined through whatever market conditions we face. While we are long-term bulls, we understand and accept that we are going to encounter markets like what we are seeing today from time to time, but we feel that we are well prepared and well positioned for the future.
Well, thanks, Matt. We spent the first part of the presentation looking at the various forces affecting the markets, including inflation, Fed policy, geopolitical risks, protectionism, and we can spend hours on these and look forward to your questions. So to that end, as we're in the final stretch, just a reminder on the Q&A section at the bottom, please add your name on there if you would like additional follow-up from your Bartlett advisor. So one question you may be asking yourself is, how will all this affect me and my family? And to help answer this question, we turn to Jason Katz. As Jim said, Jason joined Bartlett over 5 years ago from a local family office, and we told Jason he's doing great estate and tax planning work for one family. Come join us, and you can do this to benefit multiple families. And Jason's now our director of financial planning. So Jason, how do we build resilience in our financial planning process for our clients in advance of these down markets?
Yeah, thanks, Brian. If we take a step back and we think about why we even do financial planning in the first place, the answer is to help our clients build resiliency in their financial lives. Now, the challenge, of course, is we don't know what the future holds. We don't know what the twists and turns are going to be. But what we've learned is that if you build a financial plan with very predictable markets and no twists and turns, that plan is not only not realistic, but it's not resilient. So instead, we work on building plans that have conservative assumptions about the future and ones that address the many factors, both positive and negative, that can affect our clients' financial lives. And the ultimate output is a model that we all buy into and can help our clients make better and more informed financial decisions. So if there's one core concept that's woven throughout the financial planning process here at Bartlett, it's conservatism. So we're always thinking about how do we build in a margin of safety and provide confidence that the plan is realistic over time. And you're going to see this layer of conservatism in many different ways. When we plan out future cash flows, when we look at the inflation rate that we're using on expenses, investment return assumptions, as well as the longevity of our clients. We realize our clients are living longer, and it's our job to map out how their assets are going to be there to achieve their financial goals over the long term. And then on top of that, we think about what are these what if scenarios? What if we have an unexpected health event? Or maybe on the positive side, what if we want to give more money to our children or to charity? How does that work in the plan?
I know with above average inflation and below average markets this year, having conservative assumptions in the plan is comforting to both Bartlett clients and Bartlett advisors working and advising these clients. So you hear all kinds of advice about how much cash to have on hand and what role it plays in your balanced portfolio and financial plan. So how do you talk about how much cash to have on hand with your clients?
So for most of our clients, cash is comfort. So having the right amount of cash at the right time can play a huge part in making sound financial decisions. So if you take a step back and you think about the rules of thumb, first rule of thumb that comes to mind is having 6 to 12 months of expenses in an accessible bank account. And that's usually a good starting point. But what about the portfolio as a whole? How can we continue to build in a little bit more buffer to withstand a bear market? And the answer to that is to target 3 to 5 years worth of expenses in the fixed income piece of the portfolio. That fixed income bucket then becomes our source of cash when stock prices are depressed. So it allows the other side of the portfolio, the equity side, the stocks, the time to recover and prevent us from selling at lower prices.
Yeah, having cash and short-term bonds are helpful hedges in the portfolio. But what about the equity investment piece? I think in a market like this, we'd be excused for having some heartburn there and thinking about the plan. So how do you talk about that with your clients?
Yeah, investment return assumptions are really important. And we realize that years like today, we want to make sure that our financial plan is contemplating years like this one. So one way that we build that conservatism is that we don't simply assume that the returns from the past 30 years are going to equal the returns for the next 30 years. We intentionally decrease our investment return assumptions in our plan in order to build, again, that margin of safety for unexpected market conditions. The other thing that we do is we want to grow expenses at an appropriate level of inflation. So for normal living expenses, that might look like 2.5% to 3%. For healthcare expenses, maybe that's more like 5%. What we do know is that purchasing power will erode over time. And beyond that, we recognize that stocks and bonds do not move in a linear fashion. Again, reminded of that this year. But your returns don't go up 6% a year in perpetuity. So how do we account for that? We stress test the financial plan by running it 1,000 different ways with 1,000 different market scenarios, some with bull markets, but more importantly, some with protracted bear markets. And the output of that financial plan is to provide a probability of success. And success is defined as having enough money to achieve your financial goals at the end of your life. And it also, the output is to give us an educated guess as to what may be left over, whether that be for charity or for gifting to your family. And we also want to think about, once you have that base plan, how do we layer in some of these what if scenarios? I mentioned before a unexpected health event, a long-term care scenario, but it could be positive things like an increased travel budget or maybe increased gifting to your kids or to charity. We make it a point to try to plan for probabilities as opposed to possibilities.
Well, that's a thorough process, Jason. And any client that works with Jason knows he loves getting in the details with you. So given where we are in the market, stocks and bonds down this year, and everyone feeling that in their statements and appraisals. So what specific action items are you doing for clients given the market environment?
Yeah, as we've discussed, there's not been much to like in the market this year, but there's certainly planning opportunities that are attractive in these markets. But before I get into some of those tax planning ideas, I do want to bring up something that these types of markets brings forward. And it's a pretty simple idea, but the idea is understanding what your future cash needs are and then communicating those cash needs with your advisor. So I'll give you a quick example of this and how it worked out. Over the past 18 months, we've been working with a client on a significant home renovation project. So this is during all of 2021. And if you remember, the markets in 2021 were quite good. And we decided as a group to raise the money that they would need for this year, 2022, back in late 2021. So we raised all the cash that they need. And of course, it's a home renovation project. So we know what's going to happen. We're going to have budget overruns. We're going to have missed timing expectations and everything that comes with that. But we built that into the original plan. And so we were able to sell stocks at higher prices and again, not forced to sell this year in 2022. I highlight this to say that the success in the execution of this plan is really as much on the client as it is on the Bartlett team. So, you may be saying this example seems very, very elementary, budgeting and talking to your advisor about future cash needs. And you're right, it is elementary. It's a simple thing to do, but a plan doesn't have to be complex to be impactful. So now on to some tax planning opportunities that we see that are beneficial when markets are down. So the first one that comes to mind, tax loss harvesting. So this is something that is likely happening with your accounts today in taxable accounts, but this involves selling stocks or bonds that have an unrealized loss. You can sell those stocks or bonds and lock in a capital loss that can offset any other capital gains in the current year or be carried forward into the future. Now, once you sell that stock, what we usually do is we buy back something that is very similar to that. So say it's a technology stock that we sell, we might buy a technology ETF, and then 31 days later, we make a decision. Do we want to buy back the original stock that we sold? And if you do it 31 days or after, the IRS allows you to take that capital loss. So it's a concept of when the market gives you lemons, you try to make lemonade, you try to reduce your taxes. Another thing that comes to mind is really focused on those who are accumulators, those who are saving actively, 401ks, Roth IRAs. This is the time to accelerate your saving. It may not feel great right now to do that. Yeah, you may feel strapped, but these contributions tend to be very, very favorable to the long-term investor. And finally, Roth conversions might be something that you're reading about in the Wall Street Journal or another article. A Roth conversion simply is a transfer of funds from a traditional IRA to a Roth IRA. So a traditional IRA is a tax deferred vehicle, so it grows tax free, but when you take it out, it's taxable. A Roth IRA grows tax free and is tax free when you take it out. No brainer, right? Why not just convert? Well, when you do convert, it triggers an income on your tax return for that year. So why is it more attractive now? Well, since stocks have come down, maybe that level of income overall is lower than in previous years, and you'll pay less tax than you would have in another scenario. So again, this one is rarely a no-brainer, but it's one to talk to your advisor about, and you'll certainly want to bring in your CPA, as a multi-year projection is really what you need to make the decision.
Those are great, Jason. You know, a question, you know, we tend to get more frequently around this type of year is around gifting. Do you have any tips to share regarding charitable gifts or even gifts to family members?
Yeah, so in a market like this, if you looked at a top 10 list of tax planning ideas, you know, you're not going to see a lot around charitable giving. But as we say at Bartlett, we don't let tax strategy drive things like charitable giving. So I will give you one strategy that we've been doing over the past several years. It may or it may not be more beneficial this year than previous years, but it's a great strategy, and it's charitable bunching. So the idea here is that you look out several years, maybe 3 to 5 years, at what your charitable giving has been in the past, and maybe you try to predict what you want to give over that time period, and you put it in a donor advised fund. And that donor advised fund then allows you to give those funds to charity at your convenience. So you can give it out all at once, you can give it out over the next 5 or 10 years. And you know, to make this even better situation, you can give low cost basis stock to a donor advised fund, and it can become a really powerful tax savings tool, as well as achieve your charitable goals. Now, on the other side of the coin is gifting to family. And that actually is a lot more favorable in markets like we have today. So gifting can take many different forms: cash, stock, business interest, real estate. You know, all else being equal, in years like now, an asset that is depreciated in value and that you think will appreciate in the future is a really great time to gift that asset. You get that asset out of your estate and into the estate of the gift recipient. and so that all that future appreciation from here forward will be in their estate and count less against your annual or lifetime exclusion. So, if we take all of this and put it together, here's the kind of the bottom line is that building the financial plan with things like good cash buffers, conservative assumptions, employing some of these tax saving strategies all lead to a key concept. And it's all about staying invested and avoiding the behavioral penalties of selling in a down market. So in short, if you do all these things, it builds resiliency. And as my colleague Jim Haggerty often reminds us, portfolios will certainly be disrupted over time, but a carefully crafted financial plan should not be.
Well, thank you, Jason. That was well said. Well, we see the light at the end of the tunnel because we've seen it time and time again. And along the way, Bartlett has been fine-tuning our investment strategies, research process, and financial planning prowess to deliver the best care we can for you, our clients. So how far away that light is, we can't tell, but it is there, and we can make the most of the journey along the way. So we're very grateful for your confidence. And now we'd love to answer your questions, and we'll start with some of those we've already received, but feel free to continue submitting your questions, and we'll answer as many as we have time for. The first one that comes up is all direct to Aliya, and what role will China's zero COVID policy have on inflationary pricing going forward?
Yeah, so a lot of the transition of moving away from China was because of the unpredictability of their supply chains, of their factories being shut down because of COVID. Truckers have been stopped, and the product hasn't been able to move as freely as it did before COVID. And so the fact that companies can't get these parts, consumers aren't receiving the things that they've ordered in time, and a lot of that backup is going to cause, we think, higher inflation in the long run. So it may help now that companies are starting plans to reduce their reliance on China, but until that starts to play out a little bit more, until those plans are more in place, we think that China's zero COVID policy is going to continue to impact inflation.
Thanks, Aliya. Matt, I think staying on the investment or inflation theme, with globalization versus deglobalization, the question is, is there just too much money in the system that's really causing this? Just how much of the inflation is due to, the massive stimulus that we've seen fiscally and monetarily, and how much is really from supply chain?
Yeah, I'd say that's a really tough question to answer, but I'll give some thoughts. I think it's a combination of both. I can't say for sure if it's 50-50, but I think both buckets are really contributing it. Obviously, a lot of money thrown at U.S. consumers and companies, especially during the early parts of the pandemic. Some of those things are just now ending. Read an article the other day about, there's a moratorium on giving people the ability to defer payments on cars that just ended. So, you're 2.5 years in. But when you think about the impacts on the supply chain and some other things that are going on too. I mean, obviously the shutdown in China has had a tremendous impact on companies, specifically tech companies, and the ability to get iPhones and to get semiconductors. And that has resulted in tremendous amount of cost inflation. Along with it, the shipping expenses that goes with it. That's been a big part of it. More recently, thinking back to, first quarter this year, Russia's invasion of the Ukraine, that really stimulated inflation in the energy space as well as the commodity space. I mean, we saw The price of oil moved from 60, 70 up to 120. It's obviously pulled back quite a bit since then. We've seen the price of corn move from what was probably $4 or $5 a bushel. I think it got to a point where it was near $8 a bushel at one point before settling back down in the low sixes. So, it's really a handful of everything. So yeah, I wish I could say it was one or the other, and I think the Fed wishes they could say it was one or the other, but it's just a lot of different moving pieces right now.
Excellent. Yep, I think that's about as refined as we can get on quantifying the inflation attribution. Aliya, there's a question around the Israel boycott, to engage in certain countries, and maybe I don't think there's anything specific that we're doing in the ESG work, but can you maybe turn that question and be a little higher level in terms of how engaged our process is, with different international factors that are at play, and there's so many more at play every day.
Right, that's a good way to kind of phrase how Bartlett works with our clients on ESG. Bartlett itself does not have an ESG policy that we follow in particular. All of our research is really driven by client wants. So if we have a client that has a concern about boycotts in Israel, boycotts of Israel, or if we have a client that's concerned about the environment, or maybe some different social aspects as well, and diversity in the boardroom, we can really focus our efforts on a client by client basis. So we have a lot of technology available to us that helps us narrow down and focus those searches. And so really it's an exercise in, if you're interested in ESG, what are those things that you care about, and having a discussion with your advisor around how can we focus and pinpoint and do what we can in the portfolio so that it reflects your values.
Yep, perfect. Thank you, Aliya. One question that we received a couple weeks ago at this presentation was around fixed income. We spent a lot of time talking about our equity process and some of the stocks that we like, but what are we doing in fixed income? And we have a extremely robust team that stays on top of that on a daily basis. These are more attractive reinvestment yields than we've seen in over 15 years. And certainly it's a flat yield curve now, and which has its challenges there. But getting 4 or 5, almost 6% on high quality investment grade bonds is quite attractive relative to what we've seen historically. So some areas like the mortgage market, which is not loved right now because of the higher mortgage rates, those are becoming quite attractive in the market. And just high quality corporate bonds, we're seeing a nice tick up. Lastly, municipal bonds, depending on what your tax bracket is, can really drive that. But those have also sold off over 10% this year. So there's some opportunities there as well. And just the last piece tying into Jason's financial plan, we do for client cash flow needs that we know are coming up in certain calendar years, we can buy bonds that mature within those years to match the assets of your bonds with the liabilities of what your cash flow needs are, and be very rifle shot and customized in your portfolios to do that. Matt, the other question that came up was around just kind of the FANG stocks, and they've certainly been under pressure over the last month or so, and this year in general. So any thoughts around what the catalysts, maybe near term or longer term, are for those stocks, and what you're thinking there?
Yeah, just so what Brian's alluding to, FANG stocks largely consist of Facebook, Apple, formerly Google, Alphabet, Microsoft is in there, NVIDIA, there's some others. So, I think to a degree, it kind of matters by company, and all of these companies are facing, different challenges. And I think about a company like Alphabet and Meta, which was formerly Facebook. They are big players in digital advertising. So, when you're doing something on your computer or on your phone and you see an ad pop up, a lot of that technology is kind of supported by Google or Facebook. And, those are economically sensitive businesses. And, we've seen slowdowns in advertising spending. So, that's an impact, that's a headwind. But we think of that, we think of some of those things kind of as more cyclical and not structural. So things companies will work through. You think about Apple, and we've seen some headlines in the last few days again about problems getting product out of China, which we addressed earlier. COVID shutdowns of some of their main facilities is limiting the supply. And for those of you that are eager to get an iPhone 14 Pro, you might have to wait a little bit longer. They're just not available right now. So they're all facing their challenges. Microsoft too. One of Microsoft's large businesses. Consumer PCs and gaming consoles, and that business is a little bit weak as well. But I think, for most of these companies, what we do is we take a step back from, what's happening on the economy side, the cyclical nature of the business. And, as long as we don't find structural headwinds in our companies, we'll continue to own through these difficult times. And especially with some of these tech companies, they really fit, kind of the mold of what we look for in those things I highlighted to you before, that they're very high quality companies. They have big market share and leadership positions, really innovative, differentiated technology. And you look at the financial characteristics, and these are companies that have billions and billions of dollars of cash. They carry some debt, but they're net cash positive. So we've got to kind of balance the cyclical and hopefully ride through, but we believe in the long term for many of these companies, and they've been long-term winners for us and others for many, many years.
Great, thank you, Matt. The last question we'll have time for today regarding the midterm elections and some of the data we showed regarding that is, when you look back at these time periods, how many of that third year presidential election year was during a recession, and how did that impact those performance returns? I don't have the exact data on which of those years was there a recession, but I would say if we look into next year and we do see a bigger downtrend in GDP. So we see that significant negative GDP growth. The biggest correlation to that is that earnings for the companies in the S&P 500 and globally are going to be coming down. So I think that's the biggest risk to having a post midterm election rally into next year is what is the severity of the recession. And again, a mid-cycle slowdown, a mild recession or a deep recession, what comes to fruition is what is going to dictate how the equity markets and dovetailing that and the fixed income markets handle as well. So as we look into 2023, there are some things to look forward to. Historically, after inflation peaks, it's been a good time period for stocks. And with PE ratios down, 30%, it's a 30% sale to where the stocks began at the beginning of the year. Not to say 21 times was the right price of that either. Dividend payments for the S&P 500 over the last 12 months have increased 8.5%. So that's a income, the dividend paying stocks in your portfolio are raised by 8.5%. Social Security in 2023 is having a cost of living adjustment up 8.7%. And then the Medicare IRMA premiums are expected to go down 3%. And some other changes, the standard tax deduction for 2023 is going to increase as well. So with that, thank you very much for joining us today, and please reach out to your Bartlett advisor to discuss any of these topics in greater detail. Hope you have a wonderful afternoon.